You see, the U.S. government has one very important weapon to use in this crisis. It is the only debtor in the world who can legally print U.S. dollars. And the U.S. dollar is what's known as the world's reserve currency. The dollar forms the basis of the world's financial system. It is what banks around the world hold in reserve against their loans. That's a secret that most politicians don't understand. As things stand right now, the U.S. government can't go broke in any ordinary sense of the word because it can simply print dollars to pay for its bad debts. It's been doing so since March of 2009. That might sound pretty good at first. Since we can always just print more money, what is there to worry about? Well, let me show you. You see, as things stand today, America is the only country in the world that doesn't have to pay for its imports or its debts in a foreign currency. Let's say you're a German and you want to buy oil from Saudi Arabia. You can't just pay for your oil in German marks or the new euro currency because the oil is priced in dollars. So you have to buy dollars first, then buy your oil. And that means the value of the German currency is of great importance to the German government. To maintain the value of its currency, Germans must produce at least as much as they consume from around the world. Otherwise, the value of its currency will begin to fall, causing prices to rise and its standard of living to decline. But in America, we've been able to consume as much as we want without worrying about acquiring the money to pay for it because our dollars are accepted everywhere around the world. In short, for decades now, we haven't had to produce anything or export anything to get all the dollars we needed to buy all the oil and other goods our country required. All we had to do was borrow and print more money. And boy, did we. Take a look at this chart. Even as late as the 1970s, America was the world's largest creditor. But by the mid-1980s, we'd become a debtor to the world. And since the late 1990s, we've been the world's largest debtor. Today, our government owes more money to more people than anyone else in the world. And that was before the financial crisis. With all of these bad debts piling up, we've had to begin repaying our debts by printing trillions of new dollars. And now, finally, the impact of this is being felt in a big way. As our creditors continue to figure out what's happening, we're going to have very, very big problems. I believe our creditors, which includes foreign countries and other investors here and abroad, will either completely stop accepting dollars in repayment or greatly discount the value of these new dollars. I'm sure you think that sounds crazy, but as I'll show you, it is already happening. This will make our consumption-led way of life impossible to afford, and I'm confident it will lead to an end of the U.S. dollar standard. Keep in mind, the U.S. dollar has been the world's reserve currency for decades now, so most Americans don't have a clue about what the repercussions are of losing this status. And maybe you think it could never happen, but the truth is, this is exactly what happens when countries get too far in debt or when they consume too much or produce too little. In fact, the exact same thing happened to Great Britain in the 1970s. Most people don't know this, but British sterling was the reserve currency for most of the world for nearly 200 years, for most of the 18th and 19th centuries. It continued to play this role until after World War II, when America was forced to prop up Britain's economy with foreign aid. Remember the famous Marshall Plan, when we gave billions to help European countries rebuild? Unfortunately, though, Britain pursued a socialist national agenda. The government took over all of the major industries. Like Barack Obama, Britain's leaders wanted to spread the wealth around. Pretty soon, the country was flat broke. The final straw for Britain came in 1967, when things got so bad the Labour Party, the socialists, decided to devalue the British currency by 14% overnight. They believed this would make it easier for people to afford their debts. In reality, what it did was make anyone holding British sterling 14% poorer overnight, and it made everything in Britain much, much more expensive in the coming years. And, for the country as a whole, it ushered in one of the worst decades in modern British history. Most Americans don't know about Britain's winter of discontent in the late 1970s, when the government put a freeze on wages. There were continuous strikes in nearly every sector, grave diggers, trash collectors, even hospital workers. Things got so bad at one point that many hospitals were reduced to accepting emergency patients only. In 1975, inflation in Britain skyrocketed 26.9% in a single year. The government also imposed what was known as the 3-day week in 1974. In short, businesses were limited to using electricity for only 3 specified consecutive days each week, and they were prohibited from working longer hours on those days. Television companies were required to cease broadcasting at 10:30 p.m. to save electricity. The extreme problems in the economy led to Britain being nicknamed the sick man of Europe. Just how bad were things exactly? Well, here's a photo of the garbage that piled up because they didn't have enough money to pay trash collectors a fair wage. And here's what John Blackburn from Weatherby recently told the BBC television channel about his experience during this period.
I was a control engineer at Huddersfield Power Station at the time, and part of my duty was to switch off the supply to various substations around the town according to an official rota. On many an evening shift, I would have to switch off the power to my own home before going back for a candle-lit supper.
Imagine, Britain was a global superpower for 150 years, but when they started intentionally devaluing their currency, things went straight downhill. Maybe you don't think something similar can happen here, but I'm telling you, it's already underway. In fact, the exchange value of the U.S. dollar has fallen about 13% since June 2010, and its rate of decline is accelerating. What happened to the British currency is now happening to the U.S. dollar. As Barron's recently reported, when the monetary history is written decades from now, 2010 could be a watershed marking the beginning of the end of the dollar-based Western-centric monetary system. As the U.S. dollar continues to lose its position as the world's currency, gas, oil, and other commodities will continue to skyrocket. Almost everything we consume will immediately get more expensive. All the clothing, furniture, and household goods we import from China. All the food we get from Central and South America. All the electronics, television, computers, and cars we get from Asia and Europe. In fact, it's happening right now before our eyes. Everything is getting more expensive. Each week, the Wall Street Journal has a section called Cash Prices. It lists dozens of commodities, everything from wool, zinc, tin, and pork, to gold, silver, platinum, and lead. I recently checked these listings in the paper's March 1st, 2011 edition, and the numbers were mind-boggling. In short, of the 88 prices quoted, 85 items are more expensive today than they were just a year ago, many significantly so. Oil is up more than 50% from a year ago. Silver is up more than 100%. So is cotton and coffee. Tin is up 90%. Oats are up more than 70%. So is wheat. Butter is up more than 40%. So is sugar. Again, of the 88 prices quoted, the only 3 physical commodities that are cheaper today than they were a year ago: natural gas, eggs, and chickens. Everything is more expensive, in some cases much more expensive. And yet the government says there is no inflation. How is that possible? It's unbelievable to me that they think the American public is going to fall for this. U.S. businesses have certainly caught on. As Wesley Card, the head of a clothing company that includes brands like Dockers and Anne Klein, recently said, "It's really a no-choice situation. Prices have to come up." And when you look back further than a year, the numbers are even more startling. This chart shows how much a few key commodities have skyrocketed in price just since the beginning of 2009. And the point here is simple. As we print more money, the price of the world's most essential commodities have soared. This is not a coincidence. Around the world, as we print, prices soar. Citizens protest, governments get overthrown, and it's only going to get worse. Because we cannot stop printing, because we can't actually afford our existing debts. No one wants you to know this. No one. That's why, despite the obvious inflation going on all around the world, the Fed continues to say there's no inflation at all. And that's the scary part to me. Just like in a banana republic, the government is radically devaluing the dollar and totally lying to everyone about what is really happening. Whether you realize it or not, there is already a run on the dollar. Many of our creditors, like the Chinese, are getting out of the dollar as fast as they can via strategic commodities like copper. That's partly why commodity prices are soaring. Unfortunately, skyrocketing commodity prices are just the beginning. There are other disastrous consequences to the U.S. dollar losing status as the world's currency. For example, there would be much less demand for U.S. dollars around the globe, so interest rates will skyrocket. Already, just look at how quickly rates have moved up in the past 6 months. Instead of getting a mortgage at today's low rates of 5%, it may soon cost you 8%, or even 10%, or 15%. Imagine what that would do to housing prices. Stock prices will likely plummet by at least 40% in a matter of weeks as a result of this event in the currency markets. It will cost every American business a lot more money for supplies and materials. No one will be able to get a loan, and no bank will want to make loans. In short, when the U.S. dollar loses its spot as the world's reserve currency, it will cause a brutal downturn in the economy, which I expect will be about 10 times worse than the mortgage crisis of 2008. As Barron's recently reported, the demand for dollars from the rest of the world has been of inestimable benefit to the U.S. economy. It quite simply allows Americans to consume more than they produce and save less than they invest. In other words, to live beyond our means. You see, what will also happen as a result of this currency crisis and the end of the U.S. dollar as the world's reserve currency will be massive inflation, the likes of which we have never seen before. When everyone is trying to get rid of their dollars, the government is printing more and more to pay debts, and no one wants to own them, the crisis will reach epic proportions. Just look, for example, at what happened to one European country that faced this type of crisis in the 1990s. This is what happens during a major hyperinflation in the real world. In the early 1990s, the national government of one European nation had spent nearly all of its savings. So what did they do next? Simple. They began to steal the savings of private citizens by limiting people's access to their money in government-controlled banks. And of course, to finance the daily operations of maintaining their basic infrastructure, they started printing money, big time. Even so, the country's basic infrastructure began to fall apart. There were potholes in the street, broken water pipes, elevators that never got repaired, and entire construction projects that simply shut down before being completed. The unemployment rate was more than 30%, and the government just kept printing money. As San Jose State University economics professor Dr. Thayer Watkins, an expert on countries that try to inflate their way out of big debts, wrote on this particular disaster, the government tried to counter the inflation by imposing price controls. But when inflation continued, the government price controls made the price producers were getting so ridiculously low that they simply stopped producing. Bakers stopped making bread. Slaughterhouses refused to sell meat to the stores. Other stores closed down. So what did the government do next to try to curb inflation? Well, one bright idea they had was to force stores to fill out government documents every time they increased prices. They thought that this would slow down price increases because the paperwork would take so much time. But like many government plans, this one had terrible, unintended consequences. Since stores had a dedicated employee to do nothing but register this paperwork, and since the process took so long, stores began to raise prices on basic goods at even higher rates so that they didn't have to come back and file more paperwork. Incredible, isn't it? So next, the government created a new currency, which basically removed 6 zeros from the old one. So 100 million old units were soon worth 100 new units. Of course, this didn't work either. It never does. Between October of 1993 and January 1995, prices increased by, get this, 5 quadrillion %. In other words, A loaf of bread that cost $1 in 1993 suddenly cost $50 trillion and $1. Yes, that's 50 trillion. I know it's laughable, but I can guarantee that the people of this once proud European country weren't laughing one bit, especially those living on a fixed income. Of course, at this point, the country completely fell apart. As Dr. Thayer Watkins further wrote, the social structure began to collapse. Thieves robbed hospitals and clinics of scarce pharmaceuticals and then sold them in front of the same places they robbed. The railway workers went on strike and closed down the country's rail system. At this point, businesses and citizens across the country basically refused to take the local currency. Instead, everyone started dealing in German marks. Keep in mind, the daily rate of inflation was nearly 100%. Can you imagine the panic in a society when the price of just about everything doubles every single day? It was absolute pandemonium, and the economy basically came to a grinding halt. It was like living in a war zone. Truckers stopped delivering goods, stores, restaurants, and gas stations all shut down. And another ridiculous government move, the government actually made it illegal to not accept a personal check. Imagine, you could write a check, and in the several days that it typically takes for a check to clear, inflation would wipe out almost all of the cost of covering your check. Of course, as is typical, the government took none of the blame. As Dr. Thayer Watkins reported, the government's official position was that the hyperinflation occurred because of the unjustly implemented sanctions against the people and state. Again, I know what you're thinking. Just because it happened in Europe doesn't mean it can happen here, right? Well, guess what? The same thing that happened to this European country, Yugoslavia, also just happened in Iceland and Greece, but on a less dramatic scale. Of course, the only reason the situations in Greece and Iceland weren't worse is because of giant foreign bailouts. Yes, that's right. More debt to solve the problem of already existing insurmountable debts. Remember, too, that in roughly the past 100 years, this type of debt crisis has reared its ugly head in Germany, Russia, Austria, Poland, Argentina, Brazil, Chile, the Ukraine, Japan, and China. And now it is well underway in the United States. As George Mellon of the Wall Street Journal reported in late February of this year, indeed, it is unlikely that Americans themselves will escape the inflationary consequences of current Fed policy. The Fed is financing a vast and rising federal deficit following a practice that has been a surefire prescription for domestic inflation from time immemorial. If you don't believe these problems are already happening in America, just take a look. When I put together my first video presentation about this idea in November of last year, I talked about how, according to the Center on Budget and Policy Priorities, a Washington, D.C. based think tank, at least 46 states face huge budget shortfalls for 2011. And I mentioned some of the crazy things some states are doing to close their budget gap. Arizona, for example, has sold many of their government-owned buildings, including the state capitol. California is releasing more than 6,000 prisoners from jail. And nearly every state in the union is talking about legalizing some form of gambling to boost tax revenues. Of course, none of these ridiculous steps will work in the long run. And since I put together my original presentation, the situation has actually gotten much, much worse. For example, Meredith Whitney is one of the most respected analysts on Wall Street. Soon after I published my presentation last fall, Whitney went on the CBS program 60 Minutes and predicted that you could see 50 sizable local government bond defaults, 50 to 100 sizable defaults, more. This will amount to hundreds of billions of dollars worth of defaults. And if this happens, it will instantly become much more expensive, if not impossible, for state and local governments to borrow money, which means thousands of people could lose their jobs and hundreds of programs could be shut down overnight. Whitney added, "The most alarming thing about the state issue is the level of complacency. It has tentacles as wide as anything I've seen. I think next to housing, this is the single most important issue in the United States, and certainly the largest threat to the U.S. economy. New Jersey Governor Chris Christie confirmed that this problem is going on all over the country. He told 60 Minutes, "It's not like you can avoid it forever, because it's here now. And we all know it's here. And the federal government doesn't have the money to paper over it anymore, either for the states. The day of reckoning has arrived. That's it. And it's gonna arrive everywhere. Timing will vary a little bit, depending on which state you're in, but it's coming. We spent too much on everything. We spent too much. We spent money we didn't have. We borrowed money just crazily. The credit card maxed out, and it's over. It's over." The New York Times reported this weekend that New Jersey's total unfunded liability over the next 30 years has now surpassed $100 billion. That's why Christie and other governors around the country are now introducing bills to slash pension benefits to government employees. This would have been completely unthinkable just a few years ago, but now it's happening all over the country. There are huge state pension problems in Wisconsin, Indiana, Illinois, Connecticut, Hawaii, Alaska, West Virginia, Massachusetts, Delaware. The list goes on and on. And the truly amazing thing is that the U.S. federal government is in even worse shape than the local governments. The only reason we haven't seen the full brunt of this crisis yet on the federal level is because we've just continued to pile on more and more debt. The states can't print money, but the federal government can, at least for now. And for the moment, this is all that is preventing a currency collapse of unprecedented proportions. And this is the important point. What most people don't realize is that the U.S. government can only continue printing dollars as long as the U.S. dollar remains the world's reserve currency. In other words, this is all going to fall apart much sooner than people think. In fact, it's already happening. The first steps are already well underway. It is happening right now before our very eyes. For example, although it went almost completely unreported in the U.S. press, last fall a group of the world's most powerful countries, including China, Japan, Russia, and France, got together for a secret meeting without the United States being present or even knowing about the meeting. Veteran Middle East reporter Robert Fisk reported on this in Britain's independent newspaper. In the most profound financial change in recent Middle East history, Gulf Arabs are planning, along with China, Russia, Japan, and France, to end dollar dealings for oil, moving instead to a basket of currencies, including the Japanese yen, Chinese yuan, the euro, gold, and a new unified currency planned for nations in the Gulf Cooperation Council, including Saudi Arabia, Abu Dhabi, Kuwait, and Qatar. Fisk also interviewed a Chinese banker who said,
"These plans will change the face of international financial transactions. America and Britain must be very worried. You will know how worried by the thunder of denials this news will generate."
And sure enough, after Fisk published the details of this secret meeting, U.S. officials and central bankers from around the globe denied these plans. But, as the old central banking adage goes, how do you know exactly when a currency will be devalued? The answer? Right after the head of the central bank goes on television to adamantly deny that any such transaction will occur. And guess who just went public in recent weeks with a statement about how the U.S. will never devalue its currency? Yes, you guessed it. U.S. Treasury Secretary Tim Geithner. You see, the last thing a central banker wants to do in the midst of a devaluation is to give people a warning before he can devalue. So they have to deny. After the announcement is made, it's too late for citizens and investors to get out. I reported on this secret meeting last fall, and then, just a few weeks ago, a major international organization announced a big push for the end of the U.S. dollar as the world's reserve currency. On Thursday, February the 10th, the International Monetary Fund issued a report on a possible replacement for the dollar as the world's reserve currency. CNN reported the story. I'm sure you recognize the significance of this event. The IMF, which is headquartered in Washington, D.C., is the intergovernmental organization that oversees the global financial system. They are the most influential financial organization in the world economy. The IMF has proposed replacing the U.S. dollar with something called special drawing rights, or SDRs. SDRs represent potential claims on the currencies of IMF members. SDRs were created by the IMF in 1969 and can be converted into any currency based on a weighted basket of international currencies. When the IMF lends money, it typically does so via SDRs. The IMF also proposed creating SDR-denominated bonds, which could reduce central banks' dependence on U.S. Treasuries. The fund also suggested that certain assets, such as oil and gold, which are traded in U.S. dollars, could be priced using SDRs. This is a huge and important step to replace the U.S. dollar as the world's reserve currency. It's just another sign of the growing trend. Any government or investor with any sense is looking to get out of the U.S. dollar as quickly and safely as possible. For example, China holds more U.S. dollars than anyone else on the planet, and, publicly at least, China is still buying our debt. But behind the scenes, China is secretly getting out. Here's what I mean. Let's say you are China, our biggest creditor, and you hold $900 billion worth of U.S. Treasury bonds, with more coming in daily. If you are worried about the U.S. dollar, what can you do? Well, you certainly can't just start dumping dollars, because prices would collapse and you'd lose billions of dollars overnight. So instead, the Chinese are doing something very clever. They have essentially gone on a spending spree with U.S. dollars, paying basically any price to get the money into hard assets around the globe. In other words, China is getting rid of U.S. dollars without seeming to get rid of them, and thus without destroying their value. Very clever. In December, for example, China Petroleum and Chemical bought all of the oil and gas assets in Argentina belonging to Occidental Petroleum for $2.5 billion. A few weeks before that, they announced plans to buy 40% of the Brazilian operations of Spain's Repsol for $7.1 billion. That puts China's oil and gas deals in Latin America at $13.3 billion for 2010. Before that, the Aluminum Corp of China began negotiating a $19.5 billion deal with the world's largest primary aluminum company, Rio Tinto, and China Minmetals paid $1.39 billion for the world's number 2 zinc miner, Oz Minerals. And this is just the tip of the iceberg. In fact, China is buying so much, so fast, that The Economist ran a story in November 2010 called China Buys Up the World. The magazine reported, Chinese buyers, mostly opaque, often run by the Communist Party, and sometimes driven by politics as well as profit, have accounted for 1/10 of cross-border deals by value this year, bidding for everything from American gas and Brazilian electricity grids to a Swedish car company, Volvo. Sure, it might look like China is overpaying now, but when the dollar collapses, China will have protected its wealth and should even make a very nice profit. Wealthy Russian oligarchs have been using this trick for years. Instead of keeping millions of dollars in bank accounts in Russia, many pay outrageous fees for houses, sports teams, yachts, etc. Anything to get the money out of Russia so it can't be taken from them by the government. And when you look at the numbers on a percentage basis, it's clear that China is looking to hold a smaller percentage of its reserves in U.S. dollars. The number has gone from 74% in 2005 to 65% in 2010. These moves by China, of course, are just one sign of the end of the U.S. dollar standard. There are many more. Russia and China have announced an interesting agreement recently. To settle their ordinary trading of about $50 billion per year, they will no longer convert to U.S. dollars. You see, it used to be that China had to obtain dollars to buy gas supplies from Russia, but not anymore. And Russia no longer needs U.S. dollars to buy stuff from China. And this brings us to one of the biggest and most important facts regarding the U.S. dollar. As the dollar loses its place as the world's reserve currency, foreign countries will no longer need to maintain large holdings of our dollars. This means we will no longer be able to print as much money as we want. This move would have been unthinkable 10 years ago, but today it is the new reality. As I am sure you are aware, for years the US dollar has been accepted almost universally around the globe. Heck, many times when I've traveled, I never even bothered to convert to the local currency because I knew everyone would take my dollars. Well, that's simply not the case anymore. Reuters reports that the same thing has happened in 2008 in one of Europe's most popular tourist spots. Currency exchange outlets in Amsterdam have been reportedly turning away customers who want to exchange their US dollars for euros. As one traveling American told the Reuters news agency,
"Our dollar is worth maybe zero over here. It's hard to find a place to exchange. We have to go downtown to the central station or post office."
In India, the country's tourism minister said in 2008 that US dollars will no longer be accepted at the country's heritage tourist sites like the Taj Mahal, and the US dollar is no longer good anywhere in Cuba. The New York Times reports that now many shops in China no longer accept dollar-based credit cards issued by foreign banks, and foreigners cannot convert American dollars into renminbi beyond a given quota. Iran, of course, has already moved all of its reserves out of US dollars, and Kuwait depegged its currency from the dollar a few years ago. Bloomberg News recently reported that China and Russia plan to start trading in each other's currencies to diminish the dollar's role in global trade. Banu Bawija of UBS Bank said, given the risk to the dollar and U.S. assets from their fiscal position, they want to reduce their dependence on the dollar as an invoicing currency. It's even happening here in the USA. Most Americans don't know that some states in the Midwest are already using alternative currencies. An NBC News affiliate in Michigan reports that new types of money are popping up across mid-Michigan, and supporters say it's not counterfeit, but rather a competing currency. Right now, for example, you can buy a meal or visit a chiropractor without using actual U.S. legal tender. What most Americans don't realize is that this is all totally legal. The U.S. Treasury Department website says that, according to the Coinage Act of 1965, there is no federal statute mandating that a private business, a person, or an organization must accept currency or coins for payment for goods and or services. I saw one report that says there are now 150 of these alternative local U.S. currencies being accepted around the country. USA Today reports that the largest of these local currencies is a currency called Berkshires, which are being used in the Berkshire region of western Massachusetts. According to the paper, since its start in 2006, the system, the largest of its kind in the country, has circulated 2.3 million worth of Berkshires. And even in places that do not yet have local currencies, store owners may now actually prefer foreign currencies rather than U.S. dollars. In Washington, D.C., just 25 miles from my office, some stores have begun accepting euros. Of course, the euro isn't much more stable than the dollar right now, but my point is that most people don't understand there is no federal requirement in the United States for a private store to accept dollars for non-debt transactions. You see, no matter what the government decides, stores and businesses will accept whatever they believe is a strong currency. As Texas Representative Ron Paul wrote recently, if you walk into a 7-Eleven to buy a soda, the clerk doesn't have to accept your dollars. He could demand euros, silver, or copper. But because legal tender laws backing the dollar have caused the dollar to drive other currencies out of circulation, right now it is easier for stores to accept dollars. Well, all of that is quickly changing. Many places in Texas now accept Mexican pesos for payment. Euros accepted signs are popping up in, of all places, Manhattan. And not only Manhattan, but in New York's favorite summer playground, the Hamptons. There, an art gallery assistant was quoted by The Real Deal. I wouldn't want to discourage a sale in any way because of a currency issue. And it's not just small stores that are accepting other methods of payment besides U.S. dollars. The Chicago Mercantile Exchange, the world's largest futures and commodities exchange board, now accepts gold to settle futures contracts. Until recently, the exchange typically accepted only U.S. Treasury bonds as payment. These guys obviously see the writing on the wall. This would have all been completely unthinkable 10 years ago, but today it's a reality, and this trend is going to keep moving incredibly fast. That is why the smartest investors are taking action. Bill Gross, who probably knows as much about currencies and debt as anyone in the world, runs the world's biggest bond fund. He was quoted by Bloomberg saying, "We've told all of our clients that if you only had one idea, one investment, it would be to buy an investment in a non-dollar currency. That should be on top of the list." And Jim Rogers, one of the world's most successful multimillionaire investors, writes, "The dollar is not just in decline, it's a mess. If something isn't done soon, I believe the dollar could lose its status as the world's reserve currency and medium of exchange, something that would lead to a huge decline in the standard of living for U.S. citizens like nothing we've seen in nearly a century." I know, you probably still don't believe it can happen here in the United States, but think about it. Are we, as Americans, really immune to the laws of economics and finance? I don't think so. And every circumstance I know of in which a government has tried to inflate its debts away has ended in disaster. It will happen here too. As Jim Rogers says, history teaches us that such imprudent monetary and fiscal behavior has always led to economic disaster. This is why World Bank President Robert Zoellick, in a speech at the School for Advanced International Studies at Johns Hopkins University, recently said, "The United States would be mistaken to take for granted the dollar's place as the world's predominant reserve currency. Looking forward, there will increasingly be other options to the dollar." And this is why the International Monetary Fund recently called for a new global currency. This is also why big U.S. companies like McDonald's and Caterpillar have begun introducing what are called dim sum bonds. These are securities denominated in the Chinese currency, the renminbi, by non-Chinese borrowers. In other words, two of the biggest and most successful corporations in America realized they would have an easier time raising money by offering their bonds in a currency other than the U.S. dollar. Do you see where this is all heading? As Brazilian economist and strategist Ricardo Amaral wrote recently, the U.S. dollar served its purpose since the end of World War II and became the major foreign exchange reserve currency. But the days of the U.S. dollar playing that special role has reached the end of the line, since today that system is very sick and it is dying a slow death. Mr. Amaral added that we will soon see the major collapse of the U.S. dollar, creating the biggest international monetary crisis the world has ever seen. This is why gold and silver prices are soaring. The point is, it's not a matter of if the U.S. dollar will lose its status as the world's reserve currency. It's a process that is already underway. Investors, foreign governments, and large corporations know there are serious problems with the U.S. dollar, so they are fleeing to precious metals, which have historically been very reliable when a country has major currency problems. In short, it's not hard to see why people are no longer accepting U.S. dollars, and why many foreign countries are pushing for a new world reserve currency.